Oh, the beauty of traveling anywhere in the world and living a dream, even for a few days, is Airbnb's promise to travelers. It also allows anyone to earn passive income from the extra room in their house or the entire house by renting it to others through its platform. But those dreams haven't yet made the company's investors any money. The company's stock, ticker ABNB, has lost nearly 30% since its IPO, 11% of which happened after its Q1 2023 earnings report release. Would the dream ever translate to investment return for investors? And is the double-digit drop in the stock price a buying opportunity? Let's talk about that. I'm Hoda Mehr, founder and CEO of StockGuard, and on this channel I share detailed investment analysis and interesting investment stories. Airbnb's story is quite extraordinary. It is typically known as the world's largest hotel and accommodation company that owns or runs no actual buildings. In a few minutes, we will discuss this fascinating business model and how it comes through the company's extraordinary financial statements. Let's start with Airbnb's detailed fundamental analysis. As usual, we'll discuss how the company makes money and its top and bottom line trends. We explore noteworthy changes in the top and bottom lines, assess the company's balance sheet strength, and discuss its ability to generate cash to reinvest in its future. We will wrap up with the current valuation and the feasibility of the company growing into its current valuation. Let's start with Airbnb's fundamental analysis. Airbnb started as a way to rent your extra room to others for a few nights and grew into a travel industry disruptors, eating into the hotel chain's market share. It's so much easier to rent out an entire house for you and your family instead of cramping into an expensive hotel room. In Airbnb's properties, you can take your lovable giant pooch and your kids can run around while you can make a 5-course meal all from the comfort of a professionally designed and well-kept house in a new city or a country. At least that's what my family does when we travel and stay at an Airbnb. Airbnb makes money by charging people like us a booking fee when they reserve a home through its platforms. Later, the company launched a way for locals to offer tours and experiences to travelers and added a new source of booking fees. In Q1 2023, the company generated $1.8 billion in fees, up by 24%, excluding the impact of currency exchange rates. Customers booked 19% more nights and experiences this quarter compared to Q1 2022. The company is rapidly growing across all regions, including China, the EU, and Latin America, with Brazil and Germany being two of the fastest growing markets. What about the bottom line? Airbnb turned a positive net income this quarter thanks to higher interest income on its $8.2 billion in cash and cash equivalents. However, its operational loss was negative $5 million, the same as what it was in Q1 2022. There lies the first red alert. Why did the company lose the same amount of money if its revenue grew by 24% compared to a year ago? Let's investigate that. If we dig into the profit and loss statement, you'll notice some costs, such as product development and operations and support, are up, but nothing comes close to a $105 million increase in sales and marketing. In other words, the revenue was up by $309 million in exchange for $105 million in incremental sales and marketing. Most of the increase are due to good old advertising campaigns. Let's have that in mind as a risk. To grow, Airbnb has to keep piling up on digital marketing. Even though the core operations are unprofitable, Airbnb has a unique competitive advantage in its business model that we should discuss and consider. You may have heard or read this statement that the world's biggest travel company doesn't own any property, referring to Airbnb. Indeed, if you compare Airbnb with the list of lodging stocks by typing lodging in the search bar on a stocker's website, you'll see lodging stocks, and the biggest one on the list is Marriott, ticker MAR, with $54 billion in market cap, compared to Airbnb's $60 to $70 billion market cap. So you can easily see such a unique business model's advantage in Airbnb's financial figures. The company generates an impressive free cash flow. In Q1 2023, it generated $1.6 billion in free cash flow, up from $1.2 billion. This is extraordinary. Airbnb made $1.8 billion in revenue and then $1.6 billion in free cash flow. That's almost an 87% free cash flow to revenue ratio. Of course, if you dig into the company's cash flow statement, this is mostly because the company received nearly $1 billion in cash, which is not recognized as revenue this quarter. After all, people book travel well ahead of time. Airbnb's business model is a cash-generating machine, especially as we discussed earlier. It doesn't have to spend that capital and cash on purchasing and maintaining real estate and properties, which are very cash-consuming activities. No wonder the stock is priced 9 times its sales. A 9 times increase in value puts its market cap in the $640 billion range, almost the same as Meta's current $700 billion market cap. But Meta makes $117 billion in revenue, $7 billion in free cash flow, and $6 billion in profit. So at 9 times price to sales ratio, investors are expecting Airbnb to grow its revenue by 100 times, or generate more than $6 billion in profit, or more than triple its free cash flow. That's a tall order to say the least. So let's recap Airbnb's fundamental analysis. The revenue is growing by double digits. The operations are unprofitable with a significant increase in sales and marketing. The company generates a significant amount of free cash flow, representing 88% of its revenue. Airbnb has a solid balance sheet with lots of cash and no liabilities concerns. And the stock is priced at 9 times its sales. Knowing all that, what should we do with the shares? And why has the stock price dropped double digits after this latest earnings? Airbnb's stock was down significantly after the earnings report because it warned investors of a slower growth in Q2. The company explained it is due to a very difficult comparison with 2022 when people started to travel after COVID pandemic. The company is also talking about a lot of new product development. You can see that in its investments in product and development, and we heard CEO Brian Chesky talking about so many new and interesting product ideas coming through the product development pipeline to expand the company's offering beyond its core vacation rental business. This gave investors a bit of pause to wait and see what happens and what comes out in the next few quarters. But as a long-term investor, I'm not really worried about that, mostly because Airbnb's management has proven itself year after year to be able to innovate and improve the product. I am concerned about the high price to sales ratio we discussed earlier though. For my personal portfolio, I don't see any room for Airbnb. My investment strategy has three main components. 1. Regular investment in broad market indexes. 2. Reducing my portfolio size to 10 or so stocks that can grow by 100 times. And 3. Taking big risks with high reward potential investment opportunities. I'm also very patient with finding those investment opportunities. So because of my personal investment strategy, I don't add Airbnb to my portfolio. But for the reasons we discussed earlier, Airbnb can be a great investment for patient long-term investors who can accept the risk and volatility that may come of buying a stock with 9 times price to sales ratio. Now it is your turn to look up Airbnb's stock card to start your own research and share your thoughts in the comments so we can all learn from each other. The link to Airbnb's stock card and the list of hotel stocks that we discussed earlier are in the show notes for your education and entertainment. See you next time.